What is up, YouTube? This is the Working Investor. This is an update basically listening to the interview with Rod and Jay and Sylvia. Jay from YieldMax, Sylvia from Defiance, but Jay also helps out with Defiance as well. And I got a lot of clarity, especially regarding a couple funds. One of the funds I wanted to talk about is SPYT. So I did have a question in the past because they have a product called SPYT. It's the S&P 500 covered call, not a covered call, it's call credit spreads on the daily, every single day. And they have a target of 20% dividend yield annualized. And they also have a product called QQQT, which is the same thing. It's daily call credit spreads on the NASDAQ 100. And I think they're coming out soon with another one called IWMT. They are talking about it's coming out pretty soon. And that's going to be also daily call credit spreads on the Russell 2000. My burning question was, it kind of didn't seem fair initially because there's something called risk adjusted return. And the NASDAQ and the Russell 2000 have more volatility than the S&P 500. So why are they also all capped at 20%? I would expect a risk-adjusted return, that if you're picking an underlier that has greater implied volatility, then I would expect to have greater return because I would expect greater premium, and that would translate into greater dividends. So he actually mentioned in the interview, and that literally clarified everything for me. I mean, I read the prospectus or this perspecti. I did not really click until I heard it from the mouth of the fund manager. And he said, basically, these funds are also a big objective is to also appreciate the net asset value, go up in the NAV. They want to capture the upside. And basically, they will write call credit spreads as far out in the money as they can possibly get away with, just enough to get enough basis points to get an annualized 20%, ish return. And if a fund is more volatile, theoretically, or if there's a greater volatility in the market, if the VIX, is elevated, then they could potentially write further out of the money call credit spreads and have a greater safety and a greater potential way to capture the upside. So that's what he explains. So these funds are not just for the dividends, they're also very much for the appreciation. And so if you're more bullish on the NASDAQ and you feel like the NASDAQ would go up a greater percent over the long run than the S&P 500, then even though you're getting the same 20% return, you're going to theoretically capture more upside and appreciation. So that's something that really, really, really was a big clarity. Another thing that was a big clarity, and I said this too, is YBIT. I mentioned it in one of my videos, and I actually was correct about this. So YBIT is a YieldMax Bitcoin option income strategy that's based on the BITO. BITO is a futures product of Coinbase. Not Coinbase, what did I say? Coinbase, of Bitcoin. So BITO is a futures product of not the spot price, but the futures price of Bitcoin. And YBIT sells synthetic covered calls based on BITO. But BITO itself has about a 1% expense ratio. And I mentioned this in one of my videos. And I had somebody question and say, and I pointed out that if you own YBIT, you're going to be paying the yield max expense ratio, which is about, about 1%, 0.99 or 0.95. I think it's 0.99. So let's call it 1%. So about 1% in the yield max expense ratio. In addition to that, you're going to pay the expense ratio of BITO. And so you're getting 2. And of course, BITO itself pays pretty well distribution. They did pay $1.20, per share, which is amazing, which is greater than what YBIT paid to their shareholders. So that's why my argument was I rather hold BITO itself as a hold and collect dividends, and I have the flexibility of selling cover calls against my position and receive additional income, which I have been doing, and I've been getting additional pulling in at least 1 to 2% extra per month. Just, so that comes out to be 12 to 24% annualized greater boosted returns on top of the BITO distributions that they give. So, of course, things could vary in volatility and direction of Bitcoin. So to answer the person who asked the question, I don't think that you're paying a double expense ratio because they're not really holding the shares and they're kind of like running calls. But actually, Jay himself said on the interview with Rod that yes, unfortunately, it's going to be a 2%. There's going to be a 2% payment. I think it's if you go on his video, 41 minutes and 13 seconds. That's exactly where it is. And now we're going to talk about what I'm doing next. Of course, a lot of people don't like following my options. I do have some option traders who enjoy my channel. I do some videos on it. So I am running an option trade on BITX. So BITX is a 2x leverage Bitcoin strategy ETF. I don't think I've seen a leverage Bitcoin strategy high yield dividend income fund out there. I mean, the only thing I could think about is MicroStrategy, which technically is a leverage fund because they use loans to boost the return. And if you look on their charts, their volatility is almost like twice ish of Bitcoin. So I direct 2x leverage Bitcoin ETF. I could not find a dividend income paying fund. So I'm just doing it myself. I put on a trade on this fund. So basically I put it for not this week, but next week, Friday. I put a $25 put. A $25 put right now is trading around $29 and change. And I put a $25 put for $50, actually $55 in premium, which I'm to be receiving. It comes out. I did the little spreadsheet here. So basically, you could see here, I put on the trade today. It expires 10/4. It's 11 days into the trade. The spot price of BITX was trading at 29.2. 25 cash secure put. It was a 0.16 delta, which is just about one standard deviation out of the norm, which statistically makes it significant for it to move that far down. But again, it can always move that far down. I'm putting up $2,500 in collateral. My premium so far, I haven't taken off the trade yet, is $55. So if I do not pay any money to take off the trade, which I may if it goes very quickly in my direction, is $55. So I'm looking at opening the trade for a 2.2% return in about 11 days, or 73% annualized return. And again, annualized return, I know some people argue it's kind of silly to say it because if it's not repeatable, annualized return matters. If you do a one-time trade, and then you have a great annualized return when you annualize it, but you're not repeating it day in, day out, week in, week out, then it means nothing really. Because just, oh, wow, this is an annualized return for 2 days, and then you're not putting on any trades. But if you're constantly in the market and you're constantly putting up trades, you could calculate it can average your annualized return. I don't know what I did there. I did something, whatever. But the point is that, yeah, it does matter if you're repeating it. If you're consistent and repeatable, then you could get a trend of it. So yeah, this is something interesting that I'm putting on just to juice up just a little extra premium coming in, a little extra risk. One of the reasons also why I put on that strike price was, number one, the 0.16 delta, and also looking at the ranges of BITX. I mean, of course, I look at the range of Bitcoin as well. It's probably not the best entry point. It's better to put it on when Bitcoin is trading more at 54, 55,000. And so, yeah, you always, there's a good point of always looking at your actual underlier, what that it trades, because this kind of mimics what the underlier does. It's probably not the best time, but you can see here the bottom is around 22, 21, but it doesn't really stay much at 21. I see 24.50. So I figured that 25 is I tried doing 24.50, but it was not enough volume. That's one of the downsides with BITX. The volume is okay. They have weekly trades, but there's not enough open interest for my liking. But I'm just testing it out. We'll see how it goes. Anyways, this is the Working Investor over and out. I hope you guys have a great week.